my edge can actually go up to 6, 7, 8 times, and sometimes even 11 times.
Today we're joined by Javi, who's up 300,000 in the last 3 months.
You are talking to a guy who used to be the most undisciplined person.
The first undiscovered trader we've had featured in from the Philippines.
So obviously one of the edges that I layer into my system is using intraday in order to engineer a very
Semi-pro poker player, came first on the Asian Poker Tour.
your brokenness as a human being is really your path to being an extraordinary trader.
Welcome back, everybody, to Undiscovered Traders. Today we're joined by Javi, who's up 300,000 in the last 3 months and 550,000 all time. Javi is one of the, if not the first, undiscovered trader we've had featured in from the Philippines. So very nice to have you here, Javi. Little bit about him. Semi-pro poker player. Came first on the Asian Poker Tour. And he's also a portfolio manager at one of the most successful sell-side funds. Javi, welcome. Nice to have you here. What time is it?
Well, Steven, thanks for having me. It's my pleasure to be here. It is 1 a.m. 1 a.m. here in Manila.
So you're in Manila. I mean, let's just start off. We've never had anyone from the Philippines. I've never met a trader from the Philippines who's trading the US market. So can you tell me a little bit like, how's Manila? How's growing up? How did you become a trader?
Yeah, absolutely. So my journey has been relatively longer than most traders that you'll find here. I pretty much started in my professional trading career in 2010 when I made the conscious decision of putting in my 10,000 hours. 10,000 hours was pretty much a book that came out the year before in Outliers. And my stock market journey started even prior to that, back in university in 2004 when, whether it was by luck or grace, I was just asked by the school organization that I was in to organize a stock trading competition, right? Because maybe they didn't have anyone else to do it. So they asked me, a sophomore, hey, you should do this project, right, for the school. So I did that. And that pretty much started the journey with me reading books, starting with obviously Robert Kiyosaki during the time. And I'm not sure if you're familiar with the cash flow quadrant. Employed, which ends in I, which is investing. So that pretty much planted the seed in me that wanted to get into investing in stock market eventually. So that was in university, 2005. A year after university, or 2007, I opened my first brokerage account. And despite losing a lot of money in that experience, that pretty much started an obsession in the stock market, which culminated in 2010, where I decided to pursue it full time.
That's crazy. And just for the people watching, I mean, I think to make 300,000 in the last 3 months is crazy. So can you just give us a quick outline? I know that you've got a bit of a presentation. You're going to take us through some things today. Do you want to give a quick high-level outline of what you're going to run us through?
Yeah, absolutely. So, I'll start after sharing a little bit of quick background. I'm primarily a swing trader that trades the U.S. market, and here in Manila, we pretty much have a plus 12-hour time difference. So that would technically make me trading the U.S. market on night shift. At least that's what I've been doing for the last 5-6 years. And before I share my stats, the edge that I used, and some advice for beginners to at least give some color to the stats that I have on Kinfo, I'd like to start with a quick background. Just very quickly, in 2010, that's when I became a professional trader. I left a corporate career in marketing with a mindset of actually combining two concepts. So that was the 10,000 Hours by Malcolm Gladwell, which came out a year before in his book Outliers, and Hedgehog Concept, which was a book, which was a concept in the book called Good to Great by Jim Collins. And just very quickly, what the Hedgehog Concept was about, it's pretty much an intersection of 3 circles. And my mindset during the time was to really combine these 3 circles. First circle was, what was I deeply passionate about? By the time I had made the decision in 2010, I was pretty much obsessed with trading already. Starting in 2004 when I was in university, opened my first brokerage account in 2007, working full-time while trading, while trying to trade the Philippine market. And by 2010, I simply, it pretty much became an obsession. And that was really when I made the decision to go full-time. So along with being passionate about trading and financial markets, I also learned, or I also realized in 2010 that trading, or at least I thought back then, could also be an intersection of what my strengths were as an individual. Growing up, I was pretty much an average student, pretty much CC plus. But the subjects that really spoke to me and where I could really deliver an A and even teach the brightest people in my class, add value to the brightest people in my class, was math, pretty much math or any subject with numbers, right? So that was always my comfort zone as long as I put in the work. And when I combined that with also an awareness of myself at the time, where when I was in university, I always thought of myself as very big picture oriented, more of an abstract thinker, visual thinker. I would score high in the spatial scores. So that was really my decision to combine pretty much a visual kind of discipline that involved a lot of numbers. And that was classical technical analysis, right? So that was 2010, long time ago, 15 years ago. And for me, the best way to do that was to become a licensed stockbroker, pretty much servicing high net worth, ultra high net worth, starting 2010. When I started out very quickly, not only did I service high net worth individuals, ultra high net worth, sort of 100K US dollars above, but I also started servicing institutions. So back in university, I had a buddy. I was fortunate to have a buddy that eventually became the junior PM in one of the big institutions. So I started servicing them as my first client. Did that along with a fund. And then starting 2015, I decided to focus primarily on managing the fund, right? A purely discretionary fund from the sell side in the Philippines. And I think it's very important for me to place this here because this is pretty much my day job. And to be honest, this is what gives me the cash flow to fund what you could call a simple and frugal lifestyle while I make the Kinfo trading work, the trading of US markets. So this pretty much gives me or alleviates the pressure for me to make money. As you know, it's very important for traders not to have any pressure to make money, right? So this is something that I still do today, for 2 hours, 3 hours after I wake up after lunch. And obviously, as you're doing your 10,000 hours, did the CMT, that was 2016 onwards. And when you have a mindset of doing 10,000 hours, the mindset is to also, one strategy is to also teach. They say that to teach is to learn twice, right? And throughout my career, I've also decided to teach so I could learn things at a much deeper level. So from 2014 to 2019, very quickly, I taught classical technical analysis, around 120, 130 plus sessions, 5 hours each. So that was 24 to 2019. So this was my initial salvo in technical analysis. The boss that I had during the time was more of a John Murphy guy, a Martin Pring guy. Martin Pring, technical analysis explained. John Murphy, technical analysis of financial markets, right? So those were pretty much the book sources. And then in 2015, the brokerage firm I worked for had a sister school that was a trading institute that serviced people, not just my country, but people in Southeast Asia. So I was pretty much the lead lecturer and consultant for risk management. Taught that for 4 years, 5 years, and I also taught trading psychology for around 5 years. After that, left in 2019, decided to put up my own trading community with the purpose of helping these people in my country understand and trade crypto besides Philippine equities, which was what they were used to. And that was something I did for around 5 years before closing it at the end of 2023. And the last point I'll put here is I was also an attendee of the Minervini Master Trader Program 2017. And the reason why I put it here is because this was pretty much, I would say, after 8 years of putting in 8 years into my 10,000 hour journey, this, if I'm going to just go be completely honest, this was my turning point. Or the reason why it's my turning point is because if you look at Tony Robbins, the phrase that he uses is that this was this 3-day, 4-day workshop pretty much gave me the 2 millimeter shifts in the way that I thought that pretty much became responsible for miles and kilometers of improvements that I've been able to make in the years that followed, right? So it was really the learnings from here, the 2 millimeter shifts in my head that allowed me to really break out as a trader. And it was precisely because of the master trading program that I made the decision to eventually focus on trading the US stock market. And that is what brings us to Kinfo, right? To the to the track record that we have here, that I have here in Kinfo. So I measured 2 millimeter shifts. One of the 2 millimeter shifts, there's a lot, but one of the 2 millimeter shifts that I learned in the Master Trader Program was the concept of relative strength, right? Um, 8 years into my 10,000 hour journey, I learned relative strength for the first time. Obviously, not the indicator, but relative strength in the IBD William O'Neill sense. If you take a look at, let's say, for example, Lance Brightstein, right? So Lance has a concept called the broken slot machine, right? Where if you really want to be a successful trader, then you really have to prioritize what he calls the broken slot machines, or in other words, the stocks that are currently in play. And the reason why I bring this up is because what I'd like to propose to the audience is if we zoom out from broken slot machines, there's also what we can call the casinos with the highest number of broken slot machines. And as I'm sure everyone here knows, that trading is such a brutal and a very hard learning curve where the survival rate is one of the lowest across all learning curves. The one thing that we can do to really put ourselves in a position of success or to stack the odds in our favor is to trade or to put ourselves in markets that have the highest RS. And in doing the work, at least in my understanding, over a long enough period, the markets with the highest RS are pretty much the US stock market, predominantly the technology stocks, the disruptors, and also the crypto market, right? And so what we have right now is pretty much the journey, or at least the decision that I made to pursue the stock market even on a night shift, right? Or even as even with the complication of putting in health protocols, and maybe we can talk about later, in order to manage the whole night shift brotherhood of the Night's Watch side to it, right? So just very quickly, Stephen, you mentioned that I pretty much had a good year, and that's certainly true. So ever since I deposited meaningful capital into the IBKR, the Interactive Brokers account that is tracked by Kinfo, so these have pretty much been the returns, and I label it seemingly good because while most people uninitiated to trading or the stock market will see, oh wow, it's 178%, or year to date, I'm 125% up. I would be the first to tell you that if you look behind the scenes or under the hood, there's actually a lot of mistakes that were made and a lot of learnings that I would like to discuss, at least in this Kinfo interview, for the purpose of really adding value to really to the audience, right? So what I'd like to point out are the mistakes and the realizations and the process that I went through in order to avoid, if you see this, the volatile period I had over here, right? So obviously, if you look at my journey, yes, I did achieve triple-digit returns. And one thing I'd like to point out is that there's a quote here that says that the main difference between amateurs and professionals is that amateurs look at return, professionals look at risk-adjusted return, right? So if you look at the returns that I made, sure, they may look good on the surface, but if I'm going to be completely honest, the risk-adjusted return, or the risk that I had to take in order to get those returns, is something that needs meaningful improvement. And that was pretty much the process that I went through the past couple of months, just going deep into my numbers. And that's precisely the learnings that I want to share with you guys today, if that's okay, right? And
It's just a bit. I was just a bit curious, like the 400,000 up to the 100,000, the $300,000 loss made it back. $300,000 loss made it all back and more. Will you touch it later on as to what's happening behind there?
Absolutely, absolutely. I think as traders, it's very important to be brutally honest in identifying the problem, right? And obviously, I've highlighted the problem here, the months where I've had big negative drawdowns, right? Which is completely unacceptable. And if I'm going to be brutally honest with myself, the one thing that I need to accept with myself is that I am a recovering but profitable boom and bust trader, right? That was the reality that I had to deal with, and that was the reality that I had to learn from in order to, and that was a problem that I needed to solve, right? And some of you may recognize the phrase profitable or recovering boom and bust trader, because this is hat tip to Christian Flanders, right? Whose interviews that he did mostly online were primarily responsible for helping me get through my journey as well. So first is, obviously, if you look at the numbers, this is what you would call a profitable boom and buster. If I'm gonna be a trader, which God willing, I really want to be for the rest of my life, then I really need to fix the months where I drew down really bad, right? So Stephen, you mentioned the part where I dropped down from 400 to 100, right?
Yeah.
So that was December 2024, January 2025, Feb 2025, where I threw down at the bottom minus 62%. And that's something that I would never wish other traders to go through, right? And what I'm going to do is I'm going to take you through the two major lessons that I went through so I could fix that, right? And one of the things that I did was, the first thing I did was, what if I actually capped my losses or my monthly losses at minus 5%, right? And again, this is an exercise that Christian Flanders did, so hat tip to him, right? And what I realized was that if I had just changed these 3 months, August, September, and December, to minus 5%, then this figure over here in 2024 would actually be 404.84%. Huge difference. And this obviously hurt me also because this account was registered in last year's US Investing Championship. And this 178% finished at 11th place. If I had just kept my monthly losses at minus 5%, I would have finished at 4th place. Pretty much right behind Christian Flanders, with the first place finishing at plus 449%. So just that one improvement, right? If I go deeper, more than capping my monthly losses, and here's a very huge realization that I saw. Why did I have the big drawdowns? Here's the crazy part. All the large drawdowns that you'll see, whether it's July, August, September, December 2024, January, February, and here's the crazy thing. They did not happen in downtrending environments. Because you would think that I would still be pushing it in a downtrending environment. No. When the QQQs and the SP 500 was going down, I was pretty much on the sidelines. Most of these big drawdowns, these 6 large big monthly drawdowns, happened right before the market went down. That was in a sideways environment, right? So if you take a look at 2024, the market pretty much bottomed in August 5. So if it bottomed in August 5 and the market was going up and I'm a long-only trader, then how do I have the big losses, right? So for me, it was a huge realization to learn that my big down months were not in downtrending environments. They were right before the drop, like 6 weeks before the drop, and 6 weeks after the market had bottomed, right? After the market had bottomed.
And just to clarify as well, the main kind of stocks that you're trading, is it mainly like the SPY and the QQQs, or is it all large cap stocks, just for people to be aware?
Yeah, so I basically traffic in the leading names in the leading sectors, right?
Yeah.
So these are mostly technology stocks. If one sector will lead, then I'm going to choose that sector. For example, gold and monetary inflation hedges, at least for a few months last year, were leading. So I pretty much try to catch the leaders in the leading sectors. Yeah.
And how do you get started? Because like, to trade these kinds of stocks, you need a big balance to begin with for any meaningful move. To get to 500,000, you think you'd need a couple of million capital. So how did you accelerate on that?
That's a good question. If you look at the left side of the Kinfo chart from, I think this 2020, 2021, 2022, the reason why the returns were so volatile was because I only had a very small percentage of my trading capital in my US account. And typically when you have a very small percentage, then you're not really going to put yourself in a position where you're forced to learn the right processes, the right rules, right? And the right methodologies. So for me, what I wanted to do before getting bigger, just to answer your question, was start with a small account, just try to get a feel for it. And then as I am more comfortable, at least once I start to get the feel for it, and in 2023, that was when I started with a larger capital, at least a larger portion of my net worth. And that's how I ramped it up.
And how much is a large account for you, just so people can put into perspective how much you've made versus what your account size was?
I think the starting here was around 160.
Yeah.
And then right now the account is around 600,000. And over the last early this year, I withdrew the 130,000 capital.
Perfect.
Yeah.
Nice.
Yeah. So pretty much if 160 minus 130, so it's around 160. Yeah. So that was really the first realization that I made, right? That if I were really to have a chance at having a sustainable thing, at doing this trader thing, the first thing that I needed to do was to really cap my monthly losses. And one of the things that I realized also as going through this whole process is that there's this quote from the book Atomic Habits. Sorry, it's not a quote, it's more like a paraphrase. He said that whenever you experience volatility or yo-yo in your results, then it's more likely a symptom of being results-oriented rather than process-oriented in your approach, right? And as traders, we all know how important being process-oriented is. So as soon as I saw that there was a lot of volatility in my results and I was searching and going through answers, one of the things I realized that, okay, so why was I yo-yoing up and down, as you see here at the middle of the Kinfo? It was primarily because I didn't have the right rules and protocols in place. Next question is, so what rules and processes have I now put in place? And I think this is very important, especially given the current market environment. I have a rule now that every time that the monthly drawdown, both open and closed trades, reach minus 5%, then I am mandated to both reduce radically my trade size and my trade frequency. So that's basically a rule. And when I say reduce trade size and trade frequency, I mean by half. And when I mean half, I mean risking a VAR of 0.3%, 0.4%, as opposed to the normal 0.81%, right? So that's really the first thing. And that's important, especially in the sideways period that happens right before the market turns, right? Similar to what we had the past few weeks. So the second thing that I included as part of my process, and something that obviously is made popular by Mark Minervini, is progressive exposure. I was drawing down big after the market had turned because I was trying to go big, and maybe part of me was not wanting to miss the up move, right? And just just having that mindset that when the market turns, it's now go go go, and it's now time to really to go bold. The important realization here, there's a reason why that even when the market turns, it's still important to do progressive exposure and to allow traction from your own trades, feedback of success from your own trades dictate whether you go bold or not, or whether you start sizing up or not. There's this quote by Mark Minervini. He says, I think he made a tweet the other day that there are old traders and there are bold traders, but you will not find old and bold traders. Right?
Yeah, I've
And
heard that.
yeah. And that's because people who are mostly bold often get hit, and people often think that, oh, I'll just stay on the sidelines when the market goes down, or when it breaks the 10-day, right? Or if it breaks the 10-day, right? Or when the leaders start to break the 10-day. But the reality is that most of these big drawdowns happen weeks before the indices turn down and weeks after the market turns from the bottom. This was the first realization I made in terms of solving for the volatility that I had in my equity curve, right? So the second thing is understanding the why behind our trades. Because obviously, as traders, we all know that it's very important to track our trades. There's this old management guru, Peter Drucker, that says you can't really improve what you don't measure, right? And that's certainly true, not just in life, not just in business, but also in trading. But what I also like to propose is to take that a step further. Don't just measure your trades. If you really want sustainable change in terms of the habits that you're trying to kill and building new habits, if you want those to be sustainable, you need to understand the why behind your bad habits, particularly the limiting beliefs that were driving those behaviors. And through the realization of those, changing those limiting beliefs with empowering beliefs. Again, another thing that I picked up from Tony Robbins, just to go through the process that I went through in improving my equity curve, these were my numbers, right? 2024, 473 trades. So the best way to describe the way I trade is I day trade my way into swing trading, right? I mean, the intention is to hold it for a few days, but because I'm managing risk tightly, then I end up pretty much day trading most of my trades just to keep the losses tight. So 2025 so far, 350 trades. You'll see. We can go through the low win rate later, but when you're measuring your numbers, it's always very important that every time you go through a bad period, it's very important to separate the numbers, right? So through this drawdown over here in my equity curve, you'll see the numbers over here, highlighted by red. This was a 62% drawdown. That's the red table. For this move from the bottom all the way to where we are now, which is a 422% return, that's what you see in the green table, right? And for me to be able to fix my equity curve, I literally had to go through all my trades. And just going through the process of studying my trades, what I did realize was at 77%, literally 77 point two something percent of all my big losses, of all my mistakes, literally came from 3 bad habits. The first bad habit was buying the same stock during the same day after I had already cut it for a 1% VAR. And now some of you may look at this and see, okay, that's actually just a simple revenge trade behavior, right? And you cut the loss after 1%, and then during the same day you buy it back. That's what you call revenge trade. And it may sound that easy, but when I was going through at least my own self-examination, the reason why I had such a hard time getting through this hump, the reason I would always give myself is because, I was being persistent with the setup. Or in poker terms, I was being sticky, sticky with the trade. Back when I was doing this, I had this idea that revenge trading was always something that you did out of a frustrated state or an angry state, which is really why I didn't catch on this very quickly. Because when I was buying the same stock, I was pretty much doing it in a chill state. So the story I was telling myself was I was being persistent. What really got me through the hump was eventually realizing that it was the realization that ultimately it's really our habits that define us, not our intentions. We are what we repeatedly do. We are our habits. He doesn't say we are what we intend or we are the story that we have in our mind. So that was really the breakthrough, the aha moment that I had, that it is a revenge trade. Because the revenge trade is not defined by my intention. It's defined by what I repeatedly do, defined by my habits, right? And if I'm a trader that wants to break through to the next level, I need to realize that I need to be accountable for the outcome and not just the intention behind the trade in itself. This is my weakness as a person. Therefore, I need to put in a rule that basically says that it's basically a single day limit for a single stock, that if I'm already down 1 to 1.24 on a stock, then the earliest I can buy that stock is the following day. Right?
It's really hard to do that though, isn't it? Because I was just talking to my wife about this the other day, and it's saying a lot of people will take a loss and just have a victim mentality, or just think I'm going to get drunk, the market made us unlucky, I'm going to have some whiskey tonight. But not many people will just sit, analyze it to a deeper level, and just stop making the same mistake, because the ego wants to defend itself. The ego wants to not put blame on itself because it will hurt itself. And it's tough to overcome the ego and say, look, this mistake keeps on happening, and just really look into the framing of how you're looking inside at yourself. And that's exactly what you've done. But once you change the framing in your mind, it's almost like you've overcome it.
Once you change the meaning in your mind, right? And another thing that I realized that also is very helpful in this situation is when we ask ourselves why behind the bad habits that we do, what we do is we uncover the story in our head, or what you call the limiting belief, right? The stories in our head, and this is not me, this is something that Tony Robbins does at some of his seminars. He said that the stories that we tell ourselves in our head, we think that these are stories that we put up as walls to protect us. But in reality, they're not walls that protect us. They're walls that imprison us from breaking out into the kind of person, to a new person that needs with new habits that won't make this mistake, right? And that's absolutely, I thought, and it's not just with trading, but that's also in other areas of life, right?
I was talking to my wife about this the other day, and I quit drinking about 8 months ago. I stopped drinking altogether, and the amount of walls that I've broken down and successes that I've had simply for the fact that you've faced problems head on and you've not just, this bad thing happened, the market sucks, I'm going to drink a bottle of wine. It's just really looking into the fact that why am I keep on making this mistake over and over again? Like, because you could argue so many traders are undisciplined. Like 90% of traders don't have discipline, 95% don't have discipline. But like, can an undisciplined person become disciplined, or are they just forever undisciplined, or are they just not facing the problem and challenging the mind enough? Is it not just that?
You are talking to a guy who used to be the most undisciplined person, right?
The two people who used to be the most undisciplined people, you and me, I was the most undisciplined person. I'm a lot better. I'm a lot better since I quit alcohol and faced things head on. But for you as well, you just said you're the boom and bust. You're the boom and bust guy.
Yeah, the profitable I used to be. Right? So my statistics the last few months says otherwise. So I'm hoping to keep it that way. Yeah.
But can I just ask that? Is that the win rate of this year? Is that the win rate of this year that you've got up there? Is 29.43%?
Correct.
So like, what interests me is some people as well would say that's a terrible win rate for a brilliant trader. Some people would say that. And like, what's your thought there? It's just incredible discipline and knowing your process inside out.
Yeah, so what I'll say is so so I've studied the statistics of a lot of other traders, right? Traders who've competed at USIC, Market Wizards, and this is definitely a lower than usual hit rate. It's definitely on the low side. What I will say, the reason why it's on the low side is because one of the edges that I practice is because once I have a setup on the daily chart, then I usually go intraday, usually 15 minutes, to really get a very tight entry. A tight entry for a bigger move on the daily chart, right? Which means that because I'm getting a very tighter entry, then I have higher chances of getting stopped out. And because I have because I have a tight entry, the distance between my entry point and my exit is a lot smaller relative to other traders that I'm able to size more. So for what I lack in win rates, and this goes to the strength of my edge, I make up for my average gain or my edge ratio. So in the months where I'm really doing well, my edge can actually go up to 6, 7, 8 times, and sometimes even 11 times. There was a month last year where I had an 11x edge. This is during the MSTR, MST run-up. And because I know that when the market goes good and I can maximize some of the moves, then I'm okay having a lower hit rate.
No, it makes sense. Makes sense. And it's fine margins at the end of the day. It can at times be fine margins, but other times you can be absolutely killing it. It just depends on the market.
Absolutely, right? Absolutely. And I think it's very important that, yes, it was 29%, but take a look at when I was supposed to be not trading, right? It was 19%. So that's what really brought it down. That's what really brought it down, right?
So that 19% was on trades that you shouldn't have taken.
Yeah, or meaningfully reduce trade size and trade frequency.
Yeah.
The second mistake I was making was basically breaking 1% VAR, and specifically breaking 1% VAR on my A+ trades, right? And this goes back to your question, Stephen, about how do I compensate for my low win rate, right? Because if you go to one of the benefits that I've had of really going deep into at least focusing on technical analysis for the 8 years before actually learning that there was a master trader program that I attended, was I had a good idea on, because I was a setup-based trader for 8 years before joining the master trader program. I pretty much had a good idea on what my playbook of setups were, right? And among that playbook, which is 4 or 5 major playbook trades, what my A+ trade was. And going back to the mistake I was making, is that I was breaking 1% VAR on what I thought my A plus trades were, right? And the simple realization here is that, because obviously when we start, we always know that risk management is important. Most traders use a one VAR approach, right, or something lower, right? And as I was beginning my career as a trader, breaking the 1% VAR, this was like 2016, 2017, 2018, it was something that I was relatively consistent in doing, like sticking to the 1% VAR. It was only when I had a clear understanding of my A plus trade that I started breaking the 1% VAR. The fear of losing money on that A plus trade was now a lot greater than the fear of actually losing 1%. And that was really the problem that I had to deal with. And how do we go through fixing this mistake? Obviously, going through the exercise of capping monthly losses and just realizing that what really drives returns more than the A plus trade is really keeping losses to a minimum, especially during difficult times in the market, such like the one we are going through right now.
Again, it's deep. It's the deep. It's introspective. It's self analysis. It's really you take trading and you take examining yourself to a much deeper level than I've heard anyone else speak about.
Absolutely. Well, I mean, when you go through a 62% drawdown, you're forced to go. You're forced to you're really forced to figure things out. Yeah. And I mean, hopefully, as I share this, then hopefully the Kinfo listeners won't have to go through the same drawdown, right? Yeah.
In a perfect world, but I think everybody needs to lose to learn, unfortunately. Although this can make people lose a little bit less, I think.
A little less, hopefully. Yeah. Yeah. But I do agree with your statement. I mean, the hero's journey is important, right?
Yeah.
Going through that and going through the pain and the hero's journey. I think in the firm that I work with, there was this age-old debate, right? And the age-old debate was, do traders need to pretty much draw down big, pretty much get resurrected before they can ascend again into consistent profitable traders, or can they actually become consistent traders through the pain of everyday discipline, right? So that's always an age-old debate, right? And for me, I'm actually in the camp where people actually need to go through the pain of losing before they can actually have a chance at becoming a profitable trainer. And here's why. For the rules and protocols to work, rules and protocols that I just laid out right here, they need to be personal, right? Because it's like what they say, right? They say that the lessons that are most learned are the ones with strong emotions attached to those insights and lessons, right? And for you to be able to, I mean, like for example, buying the same stock same day after 1% VAR, I know I'm going to follow that rule because I know what it's like firsthand. Because that rule is not just a rule that I took from someone, that is a personal rule. And while, yes, I know that, I mean, it's a rule that I know some other traders have as well. Lance talks about daily loss limits, monthly loss limits, experiencing it yourself firsthand and attaching that pain to the lesson is what creates sustainable change.
I think so. And I mean, for me, I used to add to losers a lot in shorts, and I did it for about 8 years. And I used to oversize and just try and average up on the position to get it back lower. And it's only really been in the last recent period for me that I've just thought, I would rather not win on this trade than go through that again. Then go through the pain of the adding on the loss and adding, and then even if you win that one, you've created a bad habit that you're going to lose on the next trade when it doesn't work. And I'm just at the point now where I finally came to the realization of thinking I would just rather take this loss than go through that whole process of small win, small win, small win, because I averaged up and then massive loss. I'd rather just take the loss now. And that takes a long time. It can take 8 years to learn. It depends on the person. And eventually you learn. Eventually.
So you touched on something important there, which was the pain, right? And every trader goes through pain because every trader's, no one's perfect, and all our imperfections are manifested in our trading account. I mean, Peter Brandt said best, right? If you want to know yourself, become a trader, right?
Yeah.
Because all your imperfections come out. And the point that I wanted to bring up was that you mentioned something about pain. What I realized about how to handle pain as a trader is twofold, right? When you're in pain, you're obviously in a negative emotional state, right? Whether it's grief, whether it's anger, right? Pissed off. The best way to get yourself from a negative emotional state to a positive state, which in this case, gratitude state, is by realizing, number one, that pain is God's way, or the universe, whatever you want to use, is God's way of pointing us towards the truth. And if we don't listen, then we're going to keep experiencing that pain over and over and over again, up until the pain gets too big that you have no choice but to listen. That's the first point. The second point about pain, and this is also something I went through with going through a 62% drawdown, is that, and this is from Tony Robbins, he says that the purpose of pain is drive. Purpose of pain is drive. What that means is that when you're experiencing that pain, you need to learn how to bring yourself to a state of gratitude and saying, thank you, teacher, right? Thank you, universe. Thank you, God, for teaching me this lesson. And more importantly, you have to be able to leverage on that pain. Because as I said earlier, the best lessons, if trading is all about learning from our mistakes and becoming better, then it's very important to leverage on that pain and attach that intense emotion to the new behavior that we need to be creating moving forward, right? Because if we don't address the pain, if we just neglect it or we set it aside, then we lose the opportunity to create. We lose the opportunity, particularly the drive that comes from the pain, to be able to make that behavioral change, right? So that's at least that's what I've learned, and I hope that also speaks to what you just shared, right?
No, and I mean, I think in general in life, it's people who have a victim mentality will always have a victim mentality, and they'll never get better. And those who are willing to be mature about it and really look at themselves and the exercise, and it's about maturity at the end of the day. It's about, I think, if you meet a good trader, they've probably done a lot of growing up. They've done a lot of growing up and a lot of learning and a lot of maturing, because the best traders have these abilities to self-reflect. But I'm very curious about the types of trades that you're making.
So when I had that period of a 62% drawdown where I had relatively a low win rate and higher losses than usual for the reasons I explained, one of my saving graces was being able to maximize my wins, right? When I would look at some of my biggest winners, just objectively looking at the statistics of other people that's competed in the USIC, which is, I do it so I can learn more about myself. One of the things that I can say that is a strength of mine is that I relatively have more home runs, right? Meaning for a lot of my winners, I could say that I have more home run trades than, let's say, than the normal trader. And one of the home runs that I had, at least in September last year, was MVST, right? So just a quick background, MVST, this is a lithium battery maker, right? So if you take a look at the whole AI mega trend, so there's a stock analyst that I follow, and she basically talked about the sub trends in the AI mega trend where leaders would eventually emerge. So I would normally listen to her advice, look at the stocks in those, and see if the stocks would be leading, right? And at the start of the mega trend, it was the training stocks, meaning those that were um, the stocks would do well when in the training phase, which is stocks like Nvidia. The second was the inference phase, right, of AI, where stocks like Micron and SanDisk would do well. Those that you know dealt with a lot of memory. And then the third phase was edge AI, because for AI, obviously the bottleneck is not chips. The bottleneck is really the power generation to power all that AI. And because there's a power generation shortage to service all that AI, one of the sectors that became hot was edge AI, meaning battery sources that could actually power AI on the edge, right? Meaning on the edge of the grid. And one of those emerging leaders was MVST. So what you have right here in front of you is a chart of MVST. And what the first thing you'll notice is that it's a low cap stock, right? So $2. Normally, I don't trade stocks that are below $15 to $20. But in this particular case, when I was doing the screening and I use market search and DPU, but in particular, when I look at market search, at the time it had like I think like more than 1,000%. I think 1,400 growth prospects for 2026. It had all the qualities I was looking for: high composite rating, high up and down volume, high accumulation distribution rating, high growth. Most importantly, it had the chart was supporting an up move, right? And if you look at the move right here, it had a large up move over here and then started to base right here, right? So obviously, from a technical point of view, you could see that this was an inverted head and shoulders pattern. And what I drew here, basically, and this shows you part of my system, is that I like to use channeling techniques in order to enter stocks that are in uptrends, right? So typically, an uptrending stock will base, whether that's a falling base or a flat base. I like to use channeling techniques in order to contain that base. And around that base, I will typically have three opportunities or setups to enter that base. So I have the last bounce of support, which I'll call the aggressive entry. I have the breakout of the channel resistance, which I call the neutral entry. And then you have the pause after the breakout, the VCP, right? Which is what I call the conservative entry. So every time I'm trying to enter a stock, those are the three major setups that I'm always looking at to enter a stock: the aggressive, the neutral, and the conservative. So here at MVST, and obviously here you also see a lot of volume coming in, volume, accumulation volume coming in. So the black horizontal line represents my first entry, where I entered on the neutral entry with a stop at the low of the day, right? So obviously it breaks out. You have some nice volume on the breakout. And then as it pauses, I add another chunk, right? And by the way, this is what I would label as an A trade. So as an A trade, I would size it up to around 40, 50. Sometimes when the market is really good, 60%, 70% of the account. So you see here, I added another one, right? And then as the stock follows through higher, I pretty much use the trail. And then as it bases right here, I add here again, but a much smaller position, maybe 10 to 20% of the full position, right? Just to protect my average entry price. And then what I remember is that as this was going sideways on this very ugly candle, I got out. So if I zoom in right here, what I simply did was um, I had a low. I used the lows of these candles as a stop. And as the stock went here, then I closed the whole position. Or I believe I closed something like 70-80% of it. The reason why I closed 70-80% of it was because it was, not only a bad candle, but also of big volume or relatively bigger volume or a distribution day. So obviously the next day it goes up. I buy a smaller size over here, right? Just to bring it to maybe 40%, 30% of my original size. And then as this candle runs up on this day, I'm completely out, right? So that one trade in particular was a 24-hour trade on my account from September to October, right? So entering sometime first week September and October 16th. So this was roughly around a 20-day hold. So that would be one trade. Yep.
Yeah, and then just in general, I think you kind of went through your criteria for what you look for in a stock, but you were talking about the volume changes. I guess you mentioned that it was in a hot sector. Is there anything else when you're kind of screening that you're specifically looking for? I know you say over $20. Are you looking at like growing financials kind of thing, growing revenues, growing earnings, or?
I remember when I was looking at the details of market surge, I do remember that it was a turnaround story going from negative earnings to positive earnings, I believe this 2025, early 2025. And that was pretty much the reason for the ramp up. Typically, if it was just a company with negative earnings, then maybe I would not have sized it the way I did. If it wasn't from um, a leading sector, then I would not have sized it the way I did. I did not apply it back then, but one of the things that I'm using now to really screen and try to be more selective in my stocks, which is another major improvement that I need to work on moving forward, is just to stick to stocks that are within the top 40 sectors out of the 117 or the 100 plus sectors. So I believe that MVST at some point um, reached or became part of the leading sector, but it was not part of the criteria that I had back then when I bought MVST.
It's very interesting. And then, so I guess a part of your strategy is just reading financial books, magazines, news. I don't know if you're looking at CNBC, seeing what trends are changing in the world and thinking about what hot sector that may generate. Is it kind of like that, or there's a war all of a sudden somewhere? What sectors will that influence?
I'm generally a chart person because I come from a market where there's not a lot of stocks, and I'm coming to a market where you have a huge number of stocks and the difficulty is which to choose. I'd say that would be, if I'm going to be completely honest, the biggest weakness in my game that I need to improve moving forward. So for me to screen the stocks, to answer your question, I just simply use an up on volume screen for market surge for the day. So there's a simple button that you press, choose up on volume, and I just go through the names. I think that was how I eventually saw MVST. Yeah.
Beautiful.
Yeah. Just that.
Keep it simple. Keep it simple, stupid. That's the way.
Yeah. Yeah.
Beautiful. Do you have one more chart, or do you want to show one more to close, or do you want to or if you want, we can just go straight to kind of some tips that you might have for beginners who might want to emulate your strategy.
Yeah. So maybe we can do one more chart, right?
Sure.
So this is RGTI, right? To explain a little bit of my edge. When I attended the Master Trader Program by Minervini in 2017, one of the reasons why that was a turning point was because after that, I decided to repurpose and pretty much reorganize everything I've earned in order to trade that kind of style. But even while trying to trade that style, you realize that, eventually you're a different person, right? Like, because people are different, people will ultimately trade differently. What I did was I had to lean on strengths that I had developed in my first 8 years of putting in my 10,000 hours to complement the whole Minervini IBD William O'Neill approach. This might raise some eyebrows, but one of the things that I use to complement an IBD approach or a Minervini approach is to basically use elements of Elliott Wave that I learned in the past. I'm not saying that I use Elliott Wave. I'm saying that I use parts of it. The way I use Elliott Wave or use it to complement a setup-based approach is no different, or not no different, but it's very similar to how IBD William O'Neill traders use the Stan Weinstein's stage analysis approach. So basically, Stan Weinstein has 4 stages, right? He has neglect, advancing, topping, and then you have decline. Elliott Wave is simply the stinky, evil cousin of Stan Weinstein's stage analysis. What do I mean by that? Because if you look at Stan Weinstein's approach, if you look at neglect, advancing, topping, decline, what is neglect? Neglect is simply waves 1 and 2 in the Elliott wave, right? And the early part of 3. If you take a look at the advancing phase in Stan Weinstein's approach, that's basically wave 3 or the latter 70% of wave 3 in an Elliott wave approach, right? And then if you look at the topping phase in Stan Weinstein's, that's basically wave 4, wave 5, wave A in an Elliott wave. And if you look at the decline phase in Stan Weinstein's stage analysis, that's pretty much your wave C in an Elliott wave. And the reason why I call it the stinky, evil cousin, stinky because obviously Elliott wave has a bad, usually has a bad rap, right, in the trading community, right? And the reason why I call it evil is because Elliott wave is primarily used as a directional bias, meaning it's primarily a method used to forecast, to prognosticate, and to, to say with certainty where the market is going, which is a huge no-no for a setup-based trader, right? Meaning, in trading, a directional bias will always be the enemy of a setup-based trading approach, right? Because obviously, when you're a setup-based trader, if you look at how to make money in stocks, William O'Neill, he says, don't forecast, observe, right? In simple words, he says, trade what you see, not what you think, not where the market's going, right? Use your eyes. It's all about observation. Trade what you see. Trade the evidence that is unfolding right in front of you as opposed to where you think the market's going based on forecasts, right? So for me, as a setup-based trader, elements of Elliott Wave are what allows me to stretch my edge or to stretch my average gain, right? Because and this goes to the strength of what I think objectively is the strength of my edge or my A plus trades. Because if you think about first principles from a technical analysis point of view, if you read the literature, what does technical analysis says? Technical analysis pretty much says that, particularly Elliott Wave says the strongest part of the trend is wave 3. Meaning wave 3 is always the strongest and the longest part of the trend. It's where prices go vertical. It's the part of the trend that helps shift sentiment from negative to positive just because of how the price moves, right? And if you're going to focus your trading system to focus on just catching wave 3s, farming wave 3s, then at least that puts you in an advantage from an offensive point of view, right? And I think that it was actually being able to have that strength offense-wise, using elements of Elliott Wave to really complement my Mark Minervini IBD approach, setup-based approach that allowed me to get edges of 6, 7, 8, sometimes 11, 11x for 1 month that I had in last year, 2024, right? So, so yeah. So maybe we can, I don't know why we went on that tangent, but so when I take a look at RGTI, so obviously one of the edges that I layer into my system is using intraday in order to engineer a very calculated entry. And because it's more calculated, the distance between entry and stop is tighter, then I'm able to have a bigger size, right? So if I take a look at RGTI, so you'll see here that it topped August 15, at least in the short term, medium term, right? Nobody knows. It had a leg down and then it started to move sideways along the green blue moving average, which is a 20 and 10 day, right? And from a pattern recognition point of view, what I did realize as it was unfolding is that this was what you call like a rising wedge, or in IBD terms, a falling base in a downtrend. It's a falling base, but with an aggressive seller slope line, right? Because typically a falling base will be bounded by parallel lines, meaning price would reach here. But the fact that prices only reached, even though it made a higher high, that it only reached here was already a tell for me that the line of selling was relatively more aggressive than a usual falling base in a downtrend, right? So that really made it a candidate for me to short. And just to be clear, so I'm mainly a long base trader, so 99% of my returns are mostly on the long side, 97, 98%. And this was something that shorting is still something that I'm trying to incorporate into my overall approach. So when I go granular, once I have the base on the daily chart on the higher time frame, then I go intraday 15 minutes. So as it melted down over here, it started to go sideways, right? So full transparency, the short that I eventually put was my third attempt. So the first short that I put was here in this candle, right? Which I eventually closed here because my expectation was you rally here and go and, rally here and then move down. So I closed it here for maybe a 0.18, 0.20 VAR. And then I had another one here for a point. So basically I had around two trade. So sorry. So I put the trade here and then I put another trade here. And then I closed it here for a 0.2 VAR, right? So those were the two trades that I sold in one go. And then eventually as prices went here, and this was, as prices hit this level over here, then that's when I actually put on my next attempt short. My reason why I shorted there was because that was the 382 resistance, right? That was the 382 resistance. So obviously, if you want to buy, the best setups are, if you want to buy, you buy in the bounce of support or in the break of area pattern resistance, right? If you want to short, you want to short it as it bounces off resistance or as it's breaking area pattern support. In this case, it's bouncing off resistance, micro resistance of a larger pattern, a wedge pattern, right? And then now that you have the breakdown, so I'm just writing it. And then you have a run up here. And what I do here on the run up is that I just draw this line over here for the short-term counter trend. And then as soon as it crosses that, then I'm adding to my position. So the black line is when I add to my position. And then, so here's where things get complicated. Prices are now here at the prior low, right? So they're now at the prior low over here. But more importantly, when I look at the daily chart, it's at the 50-day, which is major support. And not only that, earnings were coming out Monday after market. I was of the impression that prices would maybe rally back up here before going through the 50-day. What I did is that I closed the short, right? So I closed like 95 majority of the short. Let's just say all of it, right? So I closed it here on this turn up on this candle over here, right? And then as it breaks down again, pretty much at the last 15 minutes of the session, then I put back 40% of my original position, right? And that's what I'm holding now while I'm with you with a stop at break even, right? And yeah, so I mean there was a lot of things going on. Obviously, you also had the Tesla thing yesterday, where if Elon's package would have been approved, then that would have been maybe a positive sentiment rally, right? So I was under the impression that maybe the 50-day was going to hold because of that. And then maybe I wouldn't have enough time to hold it prior to earnings. Because as I was doing the research, the implied volatility for RGTI on average for the last earnings is plus minus 8 point something percent. Let's just say 9% for a margin of safety, right? So for me, because it's reporting after Monday, I needed at least a buffer of 8-9% in 2 trading days for me to hold the position, right? Or let's say if I just have a buffer of 4%, then maybe I'll sell half, right? So this is the position I'm holding now. And what I'm looking at right now is, right, so if we take this out, so we're now going down in a channel. And my plan for this trade is, this is where I'm going to be looking at, which is the channel low. And my plan is, if it holds here and turns on the daily chart, then I'll close the trade. But if it pierces below the channel low, then I'm going to hold the trade. I'm going to hold the short. And the simple reason for that is because, and this goes back to, technical analysis. It's a bit of an oversimplification, but 80 to 90% of bases are pretty much contained by parallel channels. If the channel support holds, then that tells me that this is just a correction in an overall uptrend. If the channel support fails, then that tells me that we are in a advancing phase on the downside. One of the things you guys asked me to do was some advice for beginners, right? Kind of advice that I wish I knew when I started out, when I put in my 10,000 hours 15 years ago. And these are my top ones. The first thing is, you probably know by now that I really like quotes, right? Quotable quotes. And one of the quotes I put here is, knowing the enemy is half the battle won, right? And that is so important when it comes to trading. And that means, especially when you're entering the arena, particularly, the octagon that is trading, it's very important to understand the lay of the land. There's 2 aspects. First is the time aspect, right? What I mean by the time aspect is, if you simply study the history of trading, the last 130 years, you will learn that the historical learning curve on average is around 7 years. And this is not from me. This is by a historical class by John Boyk, right? Who also has books written on the subject. 130 years of Baruch, of Livermore, Wyckoff, Gerard Loeb, Darvas, who was also someone that traveled around the world and traded the US market, Dreyfus, William O'Neill, Mark Minervini, right? If you take a look at all their learning curves, the average learning curve is around 7 years. 7 years. And maybe the exception that I've seen to this, that I've seen in the 7 years, is the 3-year learning curve that they have in Trillium or SMB Capital, right? Which they do through immersion. If you understand that that's the mountain that you need to climb, then obviously the effort you put in the beginning will reflect the kind of respect that's needed, the work ethic that's needed in order to get through that 7 years. right? And that's why a lot of traders will say they'll always, share the Tony Robbins quote that people will often underestimate people will often overestimate what they can do in a year and underestimate what they can do in a decade. And for me, advice for beginners is have a decade mindset, right? That's what it took for the best in history. So the next thing I'll say when it comes to understanding the lay of the land outside of time is the chances of success. Because it doesn't mean that if you put in the time, doesn't mean that you'll be a successful trader. Whether you get the statistic from Lance Breitstein, Peter Brandt, Mark Minervini, Mark Ritchie, all of them will pretty much give you a number in the 95 to 98% range of people that enter the octagon and fail, right? And to me, this is actually very important. It's very important to understand that 95% of people fail in this business. If the failure rate is 95 to 98%, it just follows that most of the resources out there, whether it's books, market pronouncements, tips, will result in failure, right? It also means that 95 to 98% of gurus are probably furus, right? Fake gurus. So there was even this crazy statistic that I think Peter Brandt put out. I think it was a month ago, where he said that in trading, after 10 years, only 1 out of 100,000 traders will remain. I mean, that's crazy.
If it's something like that, yeah.
That's
It's just like 0.1, 0.2. Consistent
exactly
money.
right. So here's the thing. If someone at the beginning knows the statistics versus someone who doesn't know, then that person who knows the lay of the land, will they work harder or work less? Of course they'll work harder because they know how big the mountain they have to climb in front of them. And this is something that I also learned as part of my journey. I think this is something by Alec Hormozy. Obviously not in trading. He said this in the context of business. He said that confidence without competence is one of the worst things to surround yourself in business. White belts who in their mind think they're black belts, right? And if you simply break it down, the difference between your confidence and competence is really ego, right? Meaning, if your self-confidence is you think you're a 10 when you're actually a 2, then the difference 8 is pretty much the size of your ego. And obviously, we all know that ego is, bad to be. Most important advice I probably have for beginners is follow an A+ principle for meta learning. What do I mean by that? And this is the antithesis to the 95 to 98% fail rate in trading. What is A+? According to Tony Robbins, the fastest way for you to learn something is to find somebody who's already doing it successfully and just simply copy what he did as step number 1. And why is the A+ principle important? Because, and this is what Tony Robbins said, is that if you follow someone who's an A+, the highest you can ever get is an A. If you follow a C+ person, the highest you'll ever get is a C. If you follow someone who's a D who thinks he's an A, then the highest you'll probably ever get is maybe a D-, right? So in the area of trading, where 95 to 98% fail, it is absolutely crucial to really identify who the A+ people are and to just, in the words of Mark Minervini, just shut up and just listen. So what you want to do is to find the A+ traders and also see who has A+ in accessibility, right? And you want to pick the ones that are pretty much farthest out that curve. A+ traders, A+ accessibility. And for me, obviously, people will have very, very different opinions on this. From my experience, the person who was farthest out the curve in terms of A+ in skill and accessibility, that's Mark Minervini, right? with his Master Trader Program, which I think is happening this weekend. And you have the private access, right? So that's something that I would highly recommend just because of my personal experience. Obviously, I'm not connected to them in any way. Who I will also bring up, I think, who has made the fastest jump all the way to the end of that spectrum in terms of A plus trading and A plus accessibility the past couple of years is Lance Breitstein, right? With his magnum opus, where I'm also subscribed to, right? Just trying to learn from the A plus, just trying to take in every video, trying to see what I can incorporate so I can, So the formula is identify the A plus accessibility, and then also by Tony Robbins, the fastest strategy for you to get from where you are to where you want to be, which is a consistent profitable trader, is through immersion, right? That's the fastest way. And I think immersion is really the strategy that helped Trillium and SMB shorten the learning curve from 7 years to around 3 years. Even though according to some videos by Lance, they have like a 1%, a 1 in 4 retention rate for the people that they recruit. So it's a 3-year learning curve. And the reason why I think that's shortened is because obviously they're completely immersed. They're in an environment, they're in a pod where they're talking every day, and they're in a pod along with other A plus traders who are successful, right? And I think that's pretty much been maybe the fastest way or the formula I've seen to really shorten that learning curve. So step one, and this is important, find an A plus trader. And for our crypto bros out there, use that as the base layer, right? Layer one. And then layer two, the layer that you build on top of layer one, is learning the courage to march to the beat of your own drum, right? This is where after you've already taken the time to show up and learn their methodology and you're now achieving some success in the market, then you can now at least, add your own individualism to the base layer. I'll have to point out, obviously, podcasts also such as this one, Kinfo, right? What they offer are actually traders who are actually verified and transparent. I mean, we may not be at the same level as, let's say, Mark Minervini, but at least from our own personal experience, we can offer A plus moments to people who are going through the same thing. And that's the value that, let's say, podcasts like this bring to the community. So the last point that I'll maybe share, and we touched on this earlier, Stephen, is, mindset is everything. I mean, this is maybe the last Tony Robbins quote I'll probably have here. In his seminars, he always says that in anything that's performance related, whether it's, Steph Curry or sports or in business, success is pretty much 20% mechanics, 80% psychology. That's what he says. Now, obviously, we can easily debate what the percentage in trading mechanics might be. The mechanics number might be a lot bigger. The point is that if you don't have your mindset correct, as you mentioned earlier, Stephen, if you're not matured as a person, you're not going to make it as a trader because that psychological component is so important. And to even elaborate on that further, in my 15 years, at least in my humble side of the world, working with traders and having my own community back then, the biggest problem that I've seen with traders over the last 15 years is that everybody simply wants the result. Nobody wants to go through the process, right? Nobody wants to do the work. I think Mark Minervini had a tweet the other day that said that everybody wants to be a market wizard until it's time to do market wizard stuff, until it's time to put in the work, until it's time to study your trades, until it's time to do self-examination, until it's time to be not just a disciplined trader, but disciplined in other areas of your life. So the last thing maybe I'll say is, prior to me becoming a trader, I was in the field of management and leadership and, immersing myself in all of these books like John Maxwell, Chip Collins, and all these guys, Drucker. And even outside trading, one of the things that they say, and this is a solution to wanting the process and not the result. One of the things that they say is that success from a first principles point of view begins with a be, do, have mindset as opposed to a have, do, be mindset. What do I mean by this? What it means that not just in trading, but if you look at other areas and if you study successful people, rarely will you find a successful person who started with a mindset of, oh, I want to be successful because I want to have this. I want to have the big house. I want to have this sports car. I want to have, a collection of watches. I want to have a beach house here, or I want to have, this 1 million followers. That's typically the wrong place to start from a mindset point of view. And you start with what you want to have. And then based on what you want to have, you do what you do to get what you want to have. And then the person you become at the end is basically a residual result of starting with what you wanted to have in the first place, right? But instead, if you look at the most successful people, what they really start with is the question, who do I really need to become? Who do I want to become, right? That, for example, if you want to become a successful trader, then you need to ask yourself, who do I need to become in such a way that I can be a successful trader? Like what, if you look at Mark Minervini, Lance Brightseel, all these A+ market wizards and all these people that are actually have made it, more than what they have, ask them, what characteristics do they have in common, right? You can see that, I mean, you mentioned discipline earlier, right? Discipline is the one thing that stands out. Like if you look at Mark Minervini, not just the way he trades, but if you look at how he shoots, his gun competitions, you can see that he's extremely disciplined. He's extremely disciplined with his food. He's extremely disciplined with how he does all other stuff, right? If you get Lance Brightstein, he did a video like a month, 2 months ago, and the one thing that came out to me was that he literally has a list of 5 things that he has to do for that day, and he hasn't missed on that list for the last 2 years. That's discipline. And here's why that's important. The strongest force in a human being's psychology is the need to be consistent with their identity. What that means is that if you want to be a successful trader, let's say in my case, right, Stephen, you mentioned discipline. Growing up, I was the most undisciplined kid, right? I was 200 pounds as a kid growing up, eating everything left and right. And, I am of the belief, or I've learned from experience, that it's almost difficult to make it as a trader if you're disciplined in your trading, but you're not disciplined outside your trading. Why? Because if you just take a look at, let's say, chapter 1, right? Mark Minervini's book, he says that, in your trading, if you know that you're not really disciplined outside, even though no one knows, your subconscious will know. And because your subconscious know, you will be at risk of self-sabotage because of that cognitive dissonance. And part of really the process of becoming into the characteristics that you really need to get into to become a successful trader, it's self-belief is not built by shouting affirmations from rooftops. It's through daily building of evidence, right? Because you know that when you're by yourself and no one's watching, you know that you are that kind of person. You are that kind of person that deserves the kind of success because you are disciplined, because you are consistent, because you put in the work, because you do the charts every day, right? And I think that's very important. And the last point that maybe I'll end with is a quote, which, it's 15 years. It still remains to be my favorite quote. You'll see it on my Twitter handle. Brokenness is the path to extraordinary. And what that simply means is your brokenness as a human being is really your path to being an extraordinary trader. How can you not love trading? Because at the start, we talked about putting in your 10,000 hours. We think it's a 10,000-hour journey on technical skills, when ultimately trading teaching us how to become the best people that we can be. If you're someone that's reckless, if you're someone that's egotistic, guess what? you're going to see it in your trading. And that's really the beauty about trading, right? It's our own brokenness as human being that is pretty much the path to being an extraordinary trader. And in the end, as we set out to be a trader, what it really teaches us is really how to become the best human beings we can be. And
that's it, Javi. I think that's the final message. It's a beautiful message to close it out on. Very introspective, very personal. Javi, I thank you very much for your time. I want to thank you for the presentation. It was a very detailed presentation, full of knowledge and a lot of quotes of wisdom. Do check the comments to see if anyone's got questions for you to jump in on. But other than that, hopefully we'll get you on in another year or so and see where you are.
hopefully, thanks for having me. And it was my pleasure to be here. And obviously, we all have to do our part. It's such a very brutal learning curve that, if I have the opportunity to add value and contribute, then I'm happy always to do so.
That's fantastic. And that's Javi, the next Undiscovered Trader. Thank you.